way, continuing on, and then we've got diversification across markets going the other way. So we are really diversifying heavily, both in market and in system. And it's interesting, when we do these different types of systems for trend following, yes, there is a strong correlation between them, because obviously they're all addressing those trending market conditions at certain points in time. So they are quite highly correlated, but there's enough difference in the correlation to produce MAR benefits.
Yeah, the way the equity curves are being combined to come up with the optimum MAR, or the best MAR we can find out of our pool of offerings, is that we discourage consecutive trades coming at the same time. We're looking for trades that come in at different times to smooth out that equity curve. So, and that's seen by the parameters we end up with in terms of the various Donchian periods, for example. They're spread out. They're not bunched up.
What do you guys feel about the fact that the fixed target breakout system performed so well compared to the trailing stop?
I think there's a couple of things going on there. One is that the fixed take profit means we're potentially getting out of trades sooner and therefore getting in again on the same trend, whereas with the longer trend trades, if you have a wide stop, you stay in longer, which is true, but the take profit one actually comes in 2 or 3 times in the same trend. So because they are working off the same market data, I think it's just a combination. And so by combining the trend follower with the trailing stop and the take profit together, we get a combination that picks up the best of both. And I think that's a really good outcome.
Yeah, I agree. Like when we use the Donchian trader with the trailing stop, that's fairly highly volatile. But when it catches trends, it can be in them for a long time, and you can get the equity curve absolutely soaring with that. But the breakout trader is much more consistent. It's got take profit targets instead of these trailing stops. So the average holding period's a lot less than the Donchian trader. But each of them have their own virtues and characteristics. So when you blend them together, it's magnificent. But I don't think you want to lose any of them, to tell you the honest truth. They all have their strengths and weaknesses. So when you combine them, you're getting a very good result.
Yeah, it's almost like, to me, the most important element, really, well, not the most important element, but diversification seems to be the key thing here.
Yeah, diversification in strategy and also in instrument. So the more instruments you pile in with the greater variety of strategies, the broader the whole approach is, and the smoother the equity curve.
Yeah, and you end up with the question being how much diversification is enough. You know, when are you going too far? When have you got too little?
Well, that's a bit of a balancing act too. It depends on how much money you've got to trade. I mean, if you're limited to a small account size, you're probably going to be forced to sticking to something that doesn't trade that often. It doesn't have too many trades on the table at any one time, and therefore invariably you're not going to be able to diversify too wide. I mean, take the scenario where you've got 30 instruments possibly trading, and we end up with 10 different strategies. Well, there's a combination there already giving us 300 trades. So by the time you put in 5 or 6 trades against each one of those, there's a couple of thousand trades going on. So if they all trade together, we're going to run into some issues. So, if you've got a multi-million-dollar account, you can spread that across different incarnations of MT4, but for the small retail trader, that's going to be a problem. So that's why we're sharing this whole strategy with our members, and they can pick and choose and come up with their own portfolio to suit their own circumstance.
Yeah, but it certainly looks like size is an edge, or size is an advantage.
Size definitely is an advantage, but what was in the past where you had to deal with, say, $1 million or $2 million. Now with the micro lot offering, it significantly reduces that. So I'm fairly confident that we could trade a fairly robust portfolio with 100K, and if you wanted to trade with, say, 25K or 50K, you could still do it, but you would be restricted to, firstly, those instruments that offered micro lots, so you couldn't trade the mini lots that some of the things like the commodities that are only a mini lot size, you would want them, but unfortunately, because of your limited capital, you probably couldn't get them. But with something like 100K, you could definitely get very wide diversification exposure with what's on the offering today, across commodities, indices, and forex, and yeah. So look, what I might do is I thought I'd share with you some of the analytics, and we might do a walkthrough. I particularly like some of these very long-range tests. We'll look at the analysis, and then we'll look at, I think, I'll just share my screen now. So can you see my screen, gents?
Yep, got it.
Now, what I might do is I'll just bring up Euro USD. Okay, so this is, I'll just move this away. Now you can see a full screen there with Euro USD. So just looking at this, so the first step is that with this chart over here, this is an equity chart where this red line represents the equity curve over the in-sample test period. So over the in-sample test period, we generated $78,665 on the Euro USD D1. This is using the Donchian system alone. So that's a Donchian with a trailing stop. Now, the good thing about this is that if you look at the out-of-sample component here, you see that back in 1972 through to 2000, this roared, absolutely roared. Now, the thing is, because we're dealing with such a long time frame equity curve, it looks like a steady increase. But you've got to remember, this is over many, many, many years, and there is volatility embedded within this, but it looks smooth when you're dealing with such a long equity curve. But it's interesting that, for a start, we can definitely say confidently that this is not a curve fit solution, because look how it performs out of sample. Secondly, when we look at the in-sample component that generated 78,000, the full sample component generated $474,000. So it was significantly better in the out of sample component of the equity curve. Now, this particular strategy has a 41% win rate. It has a compound annual growth rate of around about 3% per year, with a maximum drawdown of 7%. So we'd need to scale this up if we traded it, because the MAR ratio on that is around about 0.5. So what that means is that at 3% compound annual growth rate and 7% drawdown, if we multiplied that by 4 or 5 times, we'd probably come out with about a 20% drawdown and around about a 15% compound annual growth rate, just on the Donchian strategy alone. So what this clearly demonstrates, and this is something that most traders don't recognize, is that when traders start these type of systems, they might have these stagnation periods. Say, for instance, this is a stagnation period that's highlighted in pink. This lasted for around about 4 or 5 years. Now, when trading that, you'd think your system was dead, wouldn't you? Because it was stagnating, it was actually declining in equity. getting nowhere. But most people would drop their systems there, but that is just the natural inherent volatility that's in this type of strategy. So this Donchian trader is very much like the old turtles trading strategy. And when people say, well, the turtles trading strategy doesn't work anymore, well, yes, it does. It still works. It's just that you go through these unfavorable regimes. So if you're not patient, and if you don't look at this from a very long-term perspective, you'll tend to think that your system's broke, as opposed to this is just a very natural part of the volatility of every system. So that's a good result, isn't it, for Euro USD?
Yeah, really good, mate.
So that's the Donchian. Now this is the breakout trader. Now look at this magnificent equity curve. Now remember how I said the Donchian, when things are trending, the profit is extreme and you get these magnificent lifts in the equity curve. But when things aren't trending as much, it's much more subdued. However, look at this breakout trader. This breakout trader is far more consistent across the entire full sample. It just demonstrates that this breakout trader, which doesn't use a trailing stop, has a fixed profit target. It's got a much shorter holding period. And so you might not get these spectacular lifts in equity, but the trade-off is you get a very nice, much more linear equity curve. So, for instance, in comparison between both these systems, we see that this one generated 78,000 in sample, 474,000 out of sample. This generated 105,000 in sample, so better than the Donchian, but less in the full sample, 334, because it didn't get the benefit of those strong trends at the beginning.
Yeah.
But that's the trade-off you get for this breakout system. Once again, this system here has a much higher win rate of 51%. But it's amazing, these equity curves. I'm so chuffed. And also look at the stagnation. So where this was stagnating was totally different to where this was stagnating. So you can imagine how then, if you combine both these strategies, you get the best of both worlds. You get this improvement over this section, which subsidises this stagnation of that system, and you get this improvement of this system, which subsidises the stagnation that occurs in this system. So that's why you'll get a better result if you blend both of them together.
Rich, can you just explain the difference between the breakout and the Donchian with regards to the actual signal to enter the trade?
Go for it, Fred.
Yeah, there's a full description on the forum, but basically speaking, what we've got with the Donchian, we're using a Donchian channel and we're waiting for a breakout of that channel. Now, we're also looking for short-term momentum. So we've got a 10-period moving average or exponential moving average. We're also looking for an uplift. If we want to go long, we're looking for a break above the channel in conjunction with a moving average that's also pointing up. So that's our entry signal. Now, depending on the Donchian look-back period and depending on the other parameter sets that are in there, we do get different entry points. But effectively, we're looking for a breakout. Now, with the breakout trader itself, it's still using a Donchian channel. We've foregone the momentum component from that, so all we're looking for is a break of the channel, and effectively we're taking profit instead of trailing. So they're very similar systems. One tends to follow the trend a lot longer with the trail. The other one's a bit shorter, but is taking short-term profits. And again, the parameter sets vary. We're taking some of those, taking profit with 1 or 2 ATR, all the way out to 10 or 12 ATR. So even though it's a take profit target, it does have some fairly lofty ambitions in terms of where it's trying to go. Both systems, both systems come in with an initial stop loss. It's set with the ATR period, and there is the opportunity to set a break-even trail as well. So they both have that same similar system. So effectively, they are pretty much the same, except for the way they exit.
I'll just show you this, Darren. So this is the Donkian. So in the Donkian, we actually have 5 separate systems. This is the Donkian period used for each of those 5 separate systems.
You want to zoom in a bit on that, Rich, and maybe lose the bottom half?
I will, mate. Okay. Can you see that clearly now, gents?
Yeah.
Glasses, mate.
So that's the 5 systems that are in that Donkian trader with the trailing stop. And this is the breakout trader. There's 5 once again in that, but notice the Donkian periods, how they differ. The ATR periods, how they differ. Stop loss multipliers. Now these parameters, values, have been generated during the optimization phase during the in-sample test. So we haven't sort of touched these. This is an outcome from the best combinations we could generate through the iterator, through the Donkian system and the breakout trader. So it's interesting how we do get this significant variation in variables here. Even though they're very similar systems, we do get variation in the variables.
I think what you're seeing there, Rich, if you look at the breakout trader, it's got a very short-term ATR period. So it means it's attuned to short-term price variances and gets in on longer-term Donkian channels. So it's looking for that short-term volatility jump, if you like, because and similarly with the take profit settings, some of those have got only a take profit of 1. So you've got a one stop loss and a 1 take profit. So it's a very fast turnaround trader just grabbing that. It's almost a sniper effect, if you like.
Yeah, I totally agree. Yeah, sniper on the momentum. And so that's why when you go to the curves, you can see we get this steady ascent because it's taking snipes, the momentum. Much shorter holding periods, unlike this, which is much longer. So much more steady ascent. That makes total sense, Fred.
Yeah.
Look, the next system we've now tested is the moving average crossover with a take profit. Fred, do you want to just tell Darren what this is about?
Yeah, well, this was I guess initially as a tongue-in-cheek approach to see whether we could make any money out of a moving average cross, because the word on the street is that you can't do it. So I thought, okay, there's a challenge. So it basically is just 2 moving averages, and when they cross, we enter, and then we use the same exit conditions as we do in our Donkian channel breaks. We've either got a take profit setting or a trailing stop, but the entry condition is purely a moving average cross. And so in terms of the parameter sets, we're giving them a broad range of settings, and the results are there on the table.
Yes. And look, what I have found, we'll get to it in a second, a comparison between the systems, but this doesn't have such a spectacular out-of-sample performance as the others. It still holds up, but it's certainly not as good as the others. When you look at it, and there's quite a long, many year stagnation here over this particular period. When we go to other markets, it might be different, but we've done a few now, but this in general seems to be indicative of this particular strategy. It's okay, but it's not as efficient and robust as the others, but we'll get to that in a sec. But in the end sample period, it generated 53,000. Just to compare that with the others, so we had 105,000 for the breakout trader, and we had 78,000 for the Donkian trader. But for this particular one, moving average take profit 53,000, a bit less profit. 95,000 for the entire sample, so not much uplift, not much difference, even though it's still increased its overall performance out of sample. not as good as the others. Its winning percentage is about 36% in sample and 36% out of sample, so it's pretty consistent in its winning percentage. This one here, this is the moving average with a trailing stop. Fred just mentioned to Darren, what's this one's about?
Yes, as we said, it's the same criteria for entry as a moving average cross, but here instead of a take profit target, we trail the exit in exactly the same manner as the Donchian and breakout traded.
So for this particular one, a better result than the take profit target using the trailing stop here. But the difference between the outer sample and the in sample, nothing really to crow about. It's still good, but I'll do now a comparison between the four. So
just before you do that, mate, do you want to jump back
Sure.
and just show us the parameter settings that we used?
Sure,
up and
mate.
there they go.
Just go to it now. Here we go. So the moving average with the take profit target, we had 9 separate strategies in that system. These are the different moving average settings.
Yeah, I just wanted to talk about that a little bit. Normally what moving average systems have a short period moving average and a long period moving average. And when the short crosses the long, we either move in the direction of the trend. This is a little bit different. We didn't put that constraint on this particular portfolio. We said, just give us a range of moving averages and we'll see what happens. And if you look at on line 24 there, you've actually got effectively a flip condition where you've got the short-term moving average, which would normally be less than the long-term, MA1 normally being the shorter of the two, is in fact longer. So what that means is that when we get across in that direction, we're effectively counter trend trading. So here we have a trend and counter trend trader all in the one scenario.
Very nice, mate.
That's happened again on line 30. We've got very similar moving averages, but slightly longer.
Yes.
Yeah, for me, this was the test that kind of indicated really that the entry doesn't really matter if you have the other elements right, but based on the other tests, you can improve greatly with an entry that takes more notice of real momentum.
Yep, agreed.
Yeah.
I mean, these moving average crossovers can happen when there's high momentum and low momentum. So essentially, it's kind of entering randomly, really. That's my feeling. I mean, am I right or wrong there?
Look, we'll do a walkthrough of it, and we'll be able to visually see what's happening. But yeah, maybe, mate. I find it hard to work it out.
Yeah, I mean, my gut feeling is it's the diversification and the management of the trades that has made this moving average crossover generate a profit.
I think you're right, but I do definitely see different degrees of performance with these different systems. So if it was just random entry, I think there's more to it than that. I don't think it is. But look, what I'll do is I'll just go here. What I've done is that's it. We've gone through the individual systems themselves with this Euro USD. So we've looked at 4 separate systems. Now what we want to do is show what happens when we start combining them all. So this is the in-sample equity curves of each of the different systems. So these 2 up the top are the Donchians, and these 2 are the moving average crossover results. Now that's in the short-term in-sample component. But look at the degree of separation you start getting over the longer term. That these 2 stand out like shining shafts of light, which are the Donchians. These are significantly outperform the moving average crosses over the very long term. So that's interesting. They're not all similar. Secondly, when I look at the entire portfolio, so what I've done is I've combined all 4 systems as though they're one portfolio and said, let's look at the outer sample component and the in sample component. So this is the result. This is the in sample equity curve, but look at this marvelous result outer sample when you combine all 4 together. It's stunning. And when you look at this overall curve here, it's pretty hard to see big drawdowns, mate, and we'll see this a bit later, but that's a good result. And then this shows the actual drawdown. So the worst drawdown we get was right at the beginning. Now, this is partly because in the first couple of years, so this is the in-sample component. Actually, no, this is incorrect.
That's the outer sample.
Here, this is the full sample curve. It's a marvelous equity curve. Now this big drawdown we get at the beginning is more a case that I've used the complete data set here from 1971, which was my earliest data. Now, realistically, I should have started in 1974 or 1975, because when we go to these parameters here and you look at the lookbacks and the moving averages, the bars, you need to leave at least 2 years or 3 years of data there for all of these to be active on the outset of the strategy. So that's why we get that. That's why we get that drawdown hit at the beginning, because only the shorter period moving averages and Donchians come in at that stage, and that's why we're getting clobbered with this high drawdown. But look at this fairly consistent level of drawdown, right, of around about 4% over the entire history. It's a very good result when you combine all 4. And what I've done here is this looks at the outer sample statistics for the whole lot. It says we've got a winning percentage of 47%. This is the monthly returns year by year from 1971 up to current day. There's some marvelous results in there. It's hard to see, but I'll try and blow them up.
You need to blow up a bit more, I think, Rich.
So 1971, we had a great year, 1973. Now remember, we are trading this entire portfolio with $100,000. So in this year, for instance, that's almost a 200% return. So each of these years, if you think of that in terms of what it is on $200,000, because remember, this is not compounding. We are not compounding these strategies. We keep the dollar risk at $500 per trade right throughout the entire history of this run. So the reality when we live trade this is, yes, we will be stepping up over the course of time with weak compounding. We won't be going aggressively, but it just gets even better than this. But this is a non-compounded result. And when you look at some of the important years, you see that you did some good results in 2015 with 87,000. 2018, you did okay, 26,000. Here we are in February. We've had a fairly good month in February. This is just Euro USD with these 4 systems.
And the euro hasn't been that flash in terms of a trend trader either, so you'll find some of the others are a lot better.
Yes.
So that's where your instrument diversification kicks in. So at the moment we're only looking at one instrument, but by spreading wider and wider, we're just going to get better and better results.
I'll just show you, this is a map to market. So just to explain this graph here, this is the entire Euro USD portfolio of 4 separate systems, and underneath it there are the individual systems underneath it. But when we look at the portfolio here and we start seeing when does the equity curve rise, so let's start, we start over here. This is where the portfolio starts. Now, the reason we get this lift in this equity curve is because this market price, which is this grey dotted line, is positively trending. And we're capitalizing on that during that period. In fact, there is a slow rise here all the way to this point. But the spectacular lift in equity, this was this magnificent trend in 2014, which we know about, and that was a significant impact on the equity curve. So you can see that we had a couple of big high impact periods which really lifted the equity curve. The other periods of time, there was slow lift or stagnation. And from 2015 onwards, it's been pretty stagnant. We get a slight lift here and we get a slight decline here. So someone trading this system in 2018 through to current day, they're not going to be happy campers because they'd have had a declining equity curve for the last 1.5 years, 2 years. And they'd be thinking, oh, this doesn't work. But you've got to view this in the context of the long term, and when trends do happen, you get these magnificent lifts. I'll just go to some of the statistics. So this is just, we have great positive skew on the entire portfolio of 2.84. This is his skew of the individual systems, all positive. This is the number of systems embedded in each one of these strategies. I'm referring to this particular result as a sub-portfolio because as we progress down the track with different markets, we'll be combining these sub-portfolios across markets to then create these combined portfolios of multi-markets and multi-systems. And Fred and I still are working on some more systems. So Fred's working on a Bollinger system. So we're going to add a few more systems. We haven't finished yet on our systems. So I'll be looking at a few more systems that'll be coming down here. And so we'll have these multi-strategy solutions.
Rich, can
yes.
we jump back to the map to market thing? Just,
yes, mate.
I just want to pose a question. I know that we, as a group, we've been over this, but we haven't really put it out to our members. So when you look at the movement of price there, we're looking at a 40-year period of the movement of price. Is it? This
is from 2000 through to 2019. This is the in-sample component, mate.
20 years.
So 20 years.
Let's say I overlaid, say, a month's worth of price movement, say, on a lower time frame. I mean, that you could see sort of similar price movements, a couple of trends and some periods of ranging. So why wouldn't this approach work on a shorter time frame? Because essentially we still see those kind of movements in the price. You know, obviously costs are greater, but if we're getting such great returns, why doesn't it work if we just kind of speed it up, if you like?
Look, I have looked at shorter time frames. One of the problems, and this is when we go to these parameters, this sort of spells it out a bit, to me at least. When we look at these Donchians here, when we look at these moving averages here, what you'll find is that the preference for the optimization and iteration is to go out to these bigger numbers. It tends not to fall on the shortest number. So if I did an optimization and iteration using a range from 0 up to 600 for the Donchian and a range of 0 up to 600 for the moving averages, after the optimization and iteration, it's going to be plugging these fairly higher figures. Now, what that tells me is that the reason it's not picking up the smaller figures is, yes, we do get trends in the smaller time frames, but by far the vast majority of price action in the shorter time frame is either random gyrations of price or mean reversion. I think mean reversion techniques suit the shorter time frames, and it's far more noisy. So I do think the reason why it is so eligible for daily, weekly, and monthly is because of the noise. And I think that's not because it doesn't trend in the lower time frames, but because as you step out to the higher time frames, the noise gets less relative. So you get more efficient trends.
Although it looks visually the same, there are actual fundamental differences.
I don't think we can jump to that conclusion categorically. I think
Okay.
there is scope to try this on different timeframes. The reality is we've started on the daily, and we've got so much work in front of us to exhaust the options here that we haven't gone back and looked. But you're right, Darren. The markets are fractal. There should be some logic to coming up with numbers. But when you're getting this sort of return, why would you bother looking any more?
Well, yeah. Well, apart from the fact that we're impatient.
Very good point. But the good point is, Darren, this is good point. If we start diversifying across markets, we're not going to have these 2-3 year waits, mate. There's going to be something happening quite regularly, and that's where the multi-market diversification comes in. So. When the Nikkei is trending, when the yen pairs are trending, that they're doing it often at different times to when the euro, the pound USD, the commodities are all trending. So with this broad diversification, then under a portfolio, what we find is that we get these beautiful linear, strong, growing portfolio equity curves that are consistently generating income. But it is, you just can't rely on it. That's all.
Yeah, I just feel it's important to cover it because, these returns are excellent. I mean, nobody should really, want anything more than what these systems do. But the reality of it is, people would, when we talk about 3 years, 5 years of not getting any uplift in your equity, then it's very hard for people to stick to that.
Can I suggest something? This might actually put a bit of light on the subject. What I find when I do an in-sample test, and I use an in-sample range, and I conduct optimization on it and this iteration process, it configures the best result over those particular conditions. So let's say I took a 2-year window.
Yeah.
Now, it produces a great result there, a lovely equity curve. And then when I apply that over an extended, broader range of market conditions, maybe 10 years, 20 years, it falls over. And that's because this process has optimized it for that particular market condition over the last 2 years, which might have been dominated by a lack of trend or some trend or mean reversion or whatever it is. So that's why I think the daily and higher timeframes work, is it forces you to go longer out to capture more market conditions if you're focusing. So therefore, I'd like to test what you're saying, Darren. I think we should do it sooner or later, but I think we should also look at our in-sample against a very long outer sample, say on H1 or an M30 or something like that, because I think that's what's going to demonstrate that these periods of time, like that's a market condition. That's one market condition of trending up. That's one market condition of trending down. This is a market condition of range bound. Here's a market condition of range bound. If I do my optimization over this section here, I'm going to get a result that gets a good equity curve responding to this particular condition. That's not trend following, that's range bound. So I'm going to get a mean reverting trader or something that performs over that period because it's been optimized. And when I apply that to a condition here, to here, to here, it's not going to work because they're totally different conditions.
Yeah. So, I mean, we're kind of working towards something that's, in theory, going to always work, as opposed to, have a great year and then fall off the cliff.
Well, I think what we're saying is these we're doing trend followers at the moment. And unfortunately, the market dictates when trends occur. Here's a trend, here's a trend, here's a trend, here's a trend, here's a trend. We can't dictate that with our system. So we will only perform during that period, that period, that period, that period, that period. We won't perform during this period. Our equity curve must be flat there because there's got to be a logical reason for the performance of our equity curve relating to trends. So it's only trending in a few positions and we catch those periods. But because we've got a trend trader, we can't expect this continual growth of equity over the entire period. We are, dictated to by the market.
Yeah, there's trends on there that we haven't capitalised, so that leads you to think, well, this particular trader is probably not the best one to pick that trend up. That's why we need to diversify and find other entry mechanisms. But I think what we're also looking for, Darren, is long-term robustness.
Sure.
If you try to run this over on a 15-minute chart, for example, and try to pick up trends, yeah, you're going to get something that sort of works, but is it going to last you for the next 10 years or is it going to fall over? Whereas by just looking at this, everything we throw it on, it performs almost better out of sample than in sample. I doubt that you'd get that sort of result from the shorter time frames.
Yeah, definitely.
Yeah.
And I think, if you're going to put 100 grand into a system, then, that is going to be one of the Achilles heels of you, because when do you pull the plug on your system? Well, if you've built a system to work on as much data as you can find and be robust, it's going to be easier to stick with that system, but if you built something on a short period of time, if you have a bad year, then do you pull the plug or not? And so we're trying to design that into our system, so you feel confident not pulling the plug and sticking with it.
Yes. The first thing you want, we're going to be committing any capital at scale for these, the first thing you want is something that doesn't fall over. If you're ponying up, say 10,000 or 5,000 or something you can afford to lose, you don't really worry about it. But when you're putting in 100,000, 200,000 or whatever, the first thing you want is something that won't lose significant money. So the first thing you need is to know that it's robust over at least what's been thrown at it over the last 50 years. If it's robust and stacks up and won't fall over, that gives you heart that even though we don't know what's coming up, it's not going to go to zero quickly.
Yeah.
So that's the first step, capital protection. Second step is, does it catch trend? So, as we step through this is the Donchian. You can clearly see the majority of this performance was attributed to this one beautiful trend here. Pretty good result here for this trending period up here. That's the Donchian. You'll see a similarity between both equity curves of the breakout trader and the Donchian trader. You'll see it outperformed in this period here. That's because of this beautiful trending condition here. But there is slight differences here to give it a slight different degree of correlation. I'll go to the correlations in a sec. When we go to the moving average, you'll see a significant difference in this system than the others. So look at it. Can you see that? That's where we get this beautiful trending for the breakout trader. We don't really get much impact on that beautiful condition for the moving average, but we get a big kick up here associated with it. It's picking on certain aspects of the trend. And it produces a different curve. So that's a bit of a...
Which is why we're trying to combine them to get the best of both worlds, isn't it?
Yes, mate. Yep.
Because this diversification of strategy deals with really subtle differences in trends.
That's right. So we might have, let's say there are 5 or 6 major trends on this chart over this period. We're trying to squeeze as much juice as we can when it trends. So we want different systems to squeeze different aspects of that trend. Here's a trailing stop. Once again, trailing stop's quite a considerable different equity curve to this one above, but it is similar in that it picks up this great trend here. So down here, that beautiful trend, it's a big lift on this one here. But what this all does is if you come here to see the degree of correlation, which is this column here, you'll see that we've got 3 that are fairly highly positively correlated, 0.82, 0.91, 0.85. This third system, this is like the black sheep in the family, and that's because we've got some counter trend in there. The correlation is lower than the others. But overall, collectively, they produce a pretty good result.
What else you got to show us, Rich?
Well, I thought, okay, it's been pretty boring so far, just looking at graphs and things. So let's do a walkthrough. So I'm going to get the best one here, and we'll do a walk. What was the breakout? I want that breakout trader. Let's have a look. Let's do this beautiful little breakout trader. So guys, as I'm setting this up, can you please talk?
So going forward, essentially we're looking to cover more markets now and build diversification across markets with these strategies, or are we adding more strategies?
Well, we're doing both. We're finding more strategies. So if anyone's got a good idea on a strategy, let us know. But the other thing we're doing is we're the iterator, if you're familiar with it, is looking for the best mark combination out of a particular strategy. What we're trying to do now is combine the strategies. Now, what Rich has shown you on the graph so far is just taking those equity curves that we've generated and putting them together as if they were trading those 4 separate strategies. Our next view is to try and get a combination together which takes the individual equity curves for all of those different iteration runs and in fact iterates across the whole lot and lets the iterator decide what the best combination is. So in that aspect, we're getting 2 different approaches to a combination. And what I'm hoping out of that is we can then again scale back and say, well, instead of running 20 trades as we have now on our 4 strategies, we can dial that back and select as many as we want. So we can go back to 10. What's the best 10 trades we can get out of the 4 different strategies, or the 8 or the 10 strategies? So there's a couple of things coming together now from the portfolio perspective.
Yeah. So basically, how we're blending the strategies together,
Correct.
Slightly different approach in the construction of the portfolio. Do you think we're going to find like a solution, like a best way to do it, or is it,
well, the jury's out because we haven't tried it, but at the moment, what Rich has done is just done a compilation of equity curves outside of MT4. The combination trader will allow us to trade those 4 strategies together in whichever configuration we want, either just combined as we're showing it now, or as a completely different blend, if you like. So once we get through that strategy, we'll be able to make a decision as to which is a better outcome.
Are you kind of surprised by these results we're getting? Because nothing falls off the cliff anymore.
Yeah, that did catch us a bit unexpectedly, and that through all the time we've been doing this, we've really not seen this type of result before.
No, I mean, everything we tried in the early days kind of looked great, but then it fall off the cliff. It's like we kind of worked out where we were going wrong with the strategies, and now it's to me it feels like the results are a little bit too good.
Yes.
Yeah. Well, we're sort of. I think all along, I don't know about you guys in terms of your education in this space, but all the time I kept hearing the words of wisdom saying, "Keep it simple, keep it the simpler you can get, the better." You don't want lots of indicators. You don't want to have a whole bunch of different decision making. What we've ended up with can't get a lot simpler, is it? Like it's a donkey and break, or it's a moving average cross. It really is the ultimate in simplicity, and I think that in itself is leading to a super robust performer, because it's based on logic. It's not just somebody's dreamt up something. It makes sense. If price breaks out of a channel, then there's a good chance it's going to continue. And all we're doing is looking for those opportunities and putting a trade on and hopefully that gives us a bit of an edge. And then by combining them together the way we have, yeah, you're right. It almost looks like magic.
Yeah, I think for me the couple of elements that are really standing out for me are that I was always a single strategy trader, and that clearly was a mistake. And I was always too much. I always kind of ignored this idea of noise, and I was always kind of too much in the noise. We seem to be giving stuff much more, extreme amounts more space than I ever gave any of my approaches before, my strategies before. Those two things really stand out to like areas where I was going wrong.
Yes, mate. Look, for me, I think what we're finding is that we engage our creative abilities in the design of these very simple systems. So we think that the best, the machines can be beaten by our creative skills in at least designing something that we know accomplishes an outcome. So in our design, we design these systems with, an initial stop, a trailing stop, asymmetrically sort of orientated to let profits run, cut losses short. So once we've engaged that creative design process, then we let the machines take over in proving that hypothesis. And so we use very long data sets. So everything we're doing here is not what you'd usually do as a retail trader. You'd be tending to use maybe 5 years of data or more recent data. You'd be using complex systems. And the reason you're using complex systems is you're training it for that recent data. You need to have complex systems to capture the essence of what's been presented at you over the last 5 years. But if you step back, relax, go back 50 years, apply these very simple systems, you recognize that there is a considerable degree of patience needed in these strategies. So let the machines do all of that, because otherwise we'll always be tempted to override it because we want to control, we want to override. So that's what this lesson has been big on me for.
Still surprised by the results, though.
Definitely, mate, definitely.
We were back against the wall for a while, and
a while, years. Yeah, I'm starting this run. Wait a sec, I'll just get it going a bit. Wait a sec. Let's get it going.
Okay, so this is the breakout trader with the fixed target exit, yeah.
Yes, mate, it's pretty ugly at the moment. Wait a sec, I'll wait till the data gets better. All right. So yes, this is the breakout trader with a fixed take profit target. Can you guys see what's happening there, or I'll just...
Data looks a bit ugly.
Yeah, this data is.
What does the curve look like? Yeah, I could live with that.
Yeah, curve looks nice.
At least it's getting the correct open price. So we only code off the open prices. We had this discussion before. So we don't have the open, high, low, close on a lot of this earlier data, but we do have the open price. So we're quite happy with this result.
Yeah, you can see there that it's taken like these short bites of the trends when they really kick in.
Yes.
There's a couple of longer periods in there. The other thing to note with the breakout trader is because it's got a set to break even level, the break even is not truly a break even. It closes out if it gets to the the opening price. So if we've got a long-term trend going, we could potentially be suffering a negative cost in terms of swap. So we may need to think about that as an offset. If that makes any sense.
Where's it go? I'll just reduce that.
Data's looking a bit cleaner now.
Yeah.
That's always a challenge, finding long-term data. In the old days, they didn't capture the open highlight close, they only captured the opening price. Yep. But yeah, for our purposes, it doesn't matter because that's the only time we make a trading decision is on the open of the bar.
That's one of, I know a lot of people have a go at MetaTrader 4 for its backtesting, but one of the great things about it is visualization. I think it's wonderful. Other backtesting software doesn't necessarily have this visualizer like this, so I can spend days just watching this.
Yeah, so it is a bit like watching paint dry. I'm not sure how entertaining it's going to be for others. I know you get your jollies on this one, mate, but
perhaps our members won't, but I get my jollies out of it. What I like about this is we're not seeing a collapse of capital. So you know how we're talking about when you put heavy capital at these strategies, at least you're not going to find that you suddenly, have no capital left.
What's also good is we're not seeing a big drawdown green line appearing anywhere.
Yeah. Fairly stagnant over this period here. But mind you,
we saw that on your graph, so it shouldn't come as a surprise. What year are we up to, Rich?
96. I know as we get towards 99, things start picking up. This is a good time for trend followers in general up towards the latter end of the 1990s. There we go, some nice shorts happening. That's a nice short trade. Bang, bang. Speed her up a bit. Otherwise, we'll all start snoring. It's probably a bit fast.
If you crunch up the time scale a bit, it makes it a bit easier to see.
How's that, mate? Better?
Yeah. Yes, there's one trade there that's been hanging in for some time, but mostly they're short-term trades, aren't they?
Yep. Some nice longs there. Yeah, look at that lift in the equity curve here with this longs. That's very nice. Yeah, early 2002. As we go into the tech collapse. That was 2002, I think.
A bit earlier than that.
Oh, geez, there's some nice longs here. It's a great looking equity curve.
Yeah, there's no massive drawdowns in there. There's hardly any, to be fair.
Yeah, I think there will be drawdowns there. It's so long term. The granularity becomes less and less. It starts looking like a nice linear line when you get to the end. It's 2008. We're going to get some nice moves here. This is the GFC. Those shorts. But the good thing is, over the in-sample component, which was from 2000, you can't see any significant difference between the outer sample and the in-sample.
Well, if anything, the out sample looks a bit better.
Yeah.
And that's a testament to the simplicity of the system, really.
Absolutely. All right. Fast track it. We should get a nice boot up with the 2004. We're coming to that perfect trend in 2014. Here we go. Down, 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 down. Beautiful. Look at the lift and the curve.
I remember that year. I was the wrong side of that trade.
We might see something similar this year, mightn't we?
Yes. We're almost home. It's been a long drive, this one. There we go. So there we are.
So what's the report look like?
I'll just wait. It's just preparing now. Good curve. Okay. Report. Profit factor 1.55 over that from 71. That's 50 years. Not a bad result.
Right.
Drawdown 14.96. Mate, that's pretty good.
That's the maximum drawdown. The absolute drawdown was only $2,900.
Yeah. Average profit trade 745. Average loss trade 496. Now, if you remember, there is no trailing stop here, so it should be close to 500, which it is. So that works. Consecutive losses 24. Consecutive wins 33. That's nice.
Yeah.
So there you go, gents. I think that's probably enough for tonight. But I think we've released the Donkian and the Breakout Trader to our members on the forum. In the next few days, we'll release the moving average take profit and moving average trailing stop. And then we're also engaging some of our members to work with us as a testing team to start applying this over a broad range of different markets. So I've still got to scope out the process there and which markets to do, and also provide the historic data, which I'm progressively doing now. So it might take a few more days before we're ready to go. But then our members will be able to do this themselves, and we want to encourage them to use those videos to start getting their teeth into this, because then they'll be able to start taking control themselves over using their data, deciding which systems they want to use, which markets they want to trade on. They can, no longer are they now dependent on us. They can start doing this for themselves.
Yeah, right. I think we should wrap it up there, guys.
Yeah, I think, really impressive work again, guys, and really keen to see what we come out with when we start adding in other markets to this. So great stuff.
Excellent.
Right.